This Reddit post asks, anyone using the permanent portfolio as a second level emergency fund? They further elaborate with, exploring splitting my emergency fund between cash and a high yield savings account in a lower volatility portfolio that consistently beats inflation. I plan to overfund the account to cushion market ups and downs. The permanent portfolio appears to historically meet both goals. This user here is essentially thinking about investing their emergency fund. And that topic, that concept of investing your emergency fund, is something that I personally feel very passionate about. Because I don't like holding cash that's essentially losing out to inflation and maybe earning a small return just from a high yield savings account. So let's jump into this further, and towards the end of the video, I'll share what I do personally for an emergency fund, or why I don't have an emergency fund. Let's look at the permanent portfolio though, and for that, I pulled it up here in Portfolio Visualizer. The permanent portfolio is comprised of 25% US stocks, 25% long-term treasuries, 25% cash, 25% gold. And when we backtest it, going back to 1978, we can see the performance has done pretty well. So an initial balance or a starting investment of $10,000 in this portfolio way back in 1978, January 1, 1978, would have grown at an annual growth rate of 7.93% to $316,000 today, with a max drawdown of only 15.58%. So the risk properties of this portfolio are indeed pretty low, but that is what you would expect from a portfolio that is holding 25% in cash right there, 25% in gold, which is relatively low volatility, and then 25% in US stocks and 25% in long-term treasuries, which usually have a very low correlation and over a short period of time can even have a negative correlation. So correlation is measured on time periods, and over a very short period of time, these two, one will zig while the other zags, but over the years, they both go up. Hence, they're going to have that positive correlation as opposed to a negative correlation. If you look at it like over a week, they're negatively correlated. Over years, they're going to be positively correlated, but they have very low correlation, so there's a lot of diversification value between these two, and I do actually run a leverage strategy using these two underlying asset classes. You have cash, which has no volatility at all, and gold. Gold is weird. It can draw down. Most people don't realize that. It can have big drawdowns, but it's also not very volatile. So all in all, you've gotten a pretty stable portfolio here. Now, let's look at the drawdowns. And actually, we'll stop here at annual returns because we can see 1979 had basically about double the return of any other year with the exception of 1982 here. This portfolio really benefited from the inflation in the late 70s, where gold was essentially the crisis alpha asset. Gold was the asset class that really did well. Now, gold is often thought of as being the inflation asset to hold, right? But that is not necessarily the case. There are other asset classes that do very well during inflationary times. They're usually gold, commodities, energy stocks, and real estate stocks. Real estate stocks not doing so well now because not only do we have the inflation, but we've also got rising interest rates. That's crushing. That is really hurting. I don't want to say crushing, but hurting real estate. Commodities and gold have done pretty well. And well, not even that. Commodities and gold have done pretty well, I guess I'll say. But energy stocks have really done the best over the last year. So it's a lot of anecdotal information. Basically, what I'm saying is gold does not always do well or do the best during inflation, and a lot of that kind of common thought that we have around gold as the inflation alpha asset stems from this year right here, 1979, and kind of in the early 80s, where as we see it, this portfolio did pretty good, and I have no doubt, without breaking it down, that gold is really the driver behind that 79 performance. So I was going to go to drawdowns. Where's drawdowns? There's drawdowns. Now, what we can see interestingly here is that the biggest drawdown is this year, this past year, 2022. 2022 was a rough year because not only was 2022 bad for stocks, but it was also bad for bonds. We saw an increase in correlation between the two asset classes that are usually very lowly correlated, and that is the long-term treasuries, and I keep scrolling around here trying to find it, and the US stock market. So 2022 for basically any stock and bond allocation is like the worst year on history. Particularly, I'd guess for anything that is more allocated heavily towards bonds, like a conservative portfolio of 40% bonds, 60% bonds, 40% stocks. That would be conservative. Moderate would be a 60-40, right? But anywhere that there's a higher allocation towards bonds, 2022 looks horrible because it was like the worst year, one of the worst years on record for bonds, if not the worst. So 2022 really kind of hammered things for bonds, and we see that here in this portfolio. Now, the big question is, how will this strategy perform going forward? And of course, nobody knows that, because if we knew that, we would all be bajillionaires, right? But that said, I broadly think that, in my opinion, that this, asset class mix here will kind of perform about the same as it has going forward. I think it might be a little less than this compound annual growth rate, but that said, it could be more. A lot of this compound annual growth rate here is as a result of these years right here in kind of the late 70s and early 80s, right when the strategy starts testing, so to say. And even through the mid 80s here. So it was growing at a pretty fast, rapid rate. Since then, it has probably slowed down a little bit. But by and large, we've got 4 diversified asset classes here. Cash, if you'd even consider that an asset class, though. Where's cash? There's cash. But gold, U.S. stocks, and long-term treasuries. Now, what could be similar to this, right? And what would I change to this strategy here or to this allocation? Well, one thing I personally don't like is gold. I think it kind of limits you to one basket that doesn't necessarily have much, one basket of things, right? One very specific thing that does not have much utility. So for that reason, I don't really like gold. I would maybe entertain replacing this with commodity basket, but that's going to increase your volatility, or energy stocks. That's another one. Gold as an inflation hedge, we really don't, know how that's going to go going forward, but personally, I'm not very convicted to it. I like holding assets that actually produce returns and have the opportunity for growth and value adding. That would be equities. So maybe, as a substitute for this, rather than holding gold, you could hold energy stocks and utility stocks. But again, that's going to make this whole thing more complicated, right? And I like simple investing. I do run some quantitative strategies, but by and large, a lot of my portfolio is in simple buy and hold stuff, and also very simple quantitative strategies. So for an emergency fund here, to start slicing and dicing these things up and split this up into 2 categories, I really don't think it's worth it because, well, there's an alternative to this, and it's a more simple alternative. And that is, what if we just did 80% bonds, total US bond market, 20% stocks? Well, let's put this in here. And we're going to do US stock market at 20, total bond market at 80 here. Okay, now the backtest doesn't go as far back, limited by the data available for the US bond market here, but we got back to 1987, and my gosh, how many years is that at this point? It's like 36 years. Holy shit. I was born in 1990, so I'm 33. But 1987 doesn't feel that long ago. But it was 33 years ago, and what we can see is that portfolio 1, which is the permanent portfolio, returns 6.56%. So when you cut out those years of late 70s, early 80s, the return does go down a bit. But the portfolio of 80% stock, or 80% bonds, US bonds, 20% stocks, so 2-fund portfolio, returned a little less at 6.39%. Okay. And that said, the drawdown was slightly higher, but that said, I don't think that this is really a material difference. To me, it's not a material difference, right? If I got this and not that, it's not going to really move the needle in my life. So for that reason, I think that the permanent portfolio kind of makes things a little bit more complex than it needs to be for a basic emergency fund. Even in the worst year for bonds on record, it was only down 16.71% when you're holding 80% in total bond market. And you don't have to rebalance as much. You could also substitute bonds for some type of tax-exempt bonds and possibly save some money there. So I like the concept of just going simple. That is my thought. Now, if you're one of those people that is like, hey, I think the economy is going to crash and gold is going to go to $10,000 an ounce or something. Right now it's probably like $2,000 an ounce. Don't know. I really don't follow the price of it. I do know that it has been on an uptrend these last few months particularly. But if that's how you feel, well, then you could just stay with the permanent portfolio, right? Like, I don't feel like there's really not a wrong choice here. I think the big choice is that you are investing it. But that said, personally speaking, between just plain old permanent portfolio and stock bond 80-20 or 20-80 allocation, I just like the 20-80 allocation. Now, ultimately, this all comes down to what works for you. There's no wrong answer here. There's no wrong answer a lot of times in investing, right? One thing that I've heard before and I fully wholeheartedly agree with is the worst thing you can do in investing is have no exposure to equities. Doesn't matter if you're 100% S&P 500 or 100% foreign equities or 100% in high fee mutual funds. That is all better than having no exposure to equities. So having your portfolio invested or your emergency fund invested in earning returns is far superior than earning no returns as long as you can stick to the strategy. So that is something you have to consider. Now, Betterment did some research on this, and I could not find the actual data, but basically, here we go. Basically, they go through, and maybe that's not it. That's not it either. Basically, they did some research, and what they found was that having about 30% of your safety net or emergency fund in stocks and 70% in bonds was the optimal risk return profile for your emergency fund, because what you need to consider personally is that you don't always need your emergency fund, right? Like, it's there for emergencies, but if you have a pretty robust, that's not a good word for this, but if you have a pretty secure job, you probably aren't going to need your emergency fund, right? Maybe you have multiple sources of income. So if you did lose your job or something, you have something else that's going to pick up the slack, right? It really depends on how much you're ultimately spending and what your lifestyle is. But if you're in a pretty secure job and you have a very low cost of living, you've done some budgeting, you've done some planning, you've maybe paid down or paid off your mortgage, you don't have much debt, well, you really don't need that emergency fund, do you? And I think a lot of people overstate or overbelieve the amount that they need in their emergency fund, right? So the emergency fund amount is something that you always have to consider. But again, are you really going to need it? So you need to factor that into the equation. Now, this user talked about over padding. That is one of their things, right? Like, maybe they figure that the maximum amount that they could need is just round numbers, simple numbers. Say $10,000, you're going to goose it up by 20% and put $12,000 in there. But then again, how much are you going to miss out on the upside by having $12,000 in a very risk-adverse portfolio? Right? That's where your downside is. And what if you don't need that all at one time? Right? Maybe you only need $1,000 or $2,000 at a time. Then maybe it's worth it to invest in something that is more aggressively positioned, like 40% or 30% or 60% stocks, and then a lower amount in bonds. And ultimately you pull that, return back to yourself. If you need cash, you can either A, sell your investments, or B, and this is what I do, and keep in mind, this is not financial advice for yourself. This is what I do, and I'm sharing my own experience. And it is also very high risk, or not very high risk, but it's high risk. So keep that in mind, is I would use a margin loan for that, right? So you can withdraw from brokerages that have margin available. You can withdraw, create a negative cash balance. The amount of interest is then added to your negative cash balance. And from certain brokers like M1 Finance has a very low margin rate, particularly for their M1 Plus, but Interactive brokers, the margin rates are incredibly low. So their base rate plus something. At Interactive brokers with Interactive Brokers Pro, I know I pay base rate plus 1.5%. Right now, I think that's at like 6.5%. I don't follow it to the T day by day, but again, that is what I would fundamentally use as my emergency fund. Now, keep in mind that works for me because of my lifestyle, my streams and sources of income that I have coming in. I do have multiple sources of income. So If I lost one of them, it really wouldn't be the end of the world. And I do have a relatively low cost of living and a pretty high savings rate relative to the amount of money that I earn. So that works for me. And I also have built up a pretty nice little, nest egg that can sustain it. So that's what works for me. And I'd rather just keep my money invested in an 80-20 portfolio. That's 80% stocks, 20% bonds. That's going to earn me returns and know that, hey, if I ever need it, I can pull out on margin. So that is my thoughts on using the permanent portfolio as a second level emergency fund, and broadly speaking, investing your emergency fund in general and an alternative to having an emergency fund. What I do, guys. Hey, on that note, if you found this video helpful and insightful, you know the drill. Be sure to smash that like button. Smash that like button for me. I'm serious about it. And hit that subscribe button to get all of my latest insights into investing here and what I share on the channel. The like button helps me out in the YouTube algorithm. And if you feel like there's anything that I missed out on or didn't cover, do let me know in the comments below.